Listen carefully. What I'm about to break down might just flip your entire perspective on this market. Bitcoin just ripped nearly 9% in a matter of days. If you've been on social media, you've seen it. The euphoria is back. Influencers are calling the bottom. Bull market back on is all over your feed. Everyone's getting excited, right? But what if this bounce isn't a sign of strength? What if it's the setup for the next big move down? Because while the price was pumping, something far more important was happening right underneath the surface, something most people are completely missing. Leverage. It flooded into the market aggressively. We're talking billions of dollars in new long positions stacked up incredibly fast. And if you look at the historical data, when this kind of insane leverage piles in during a relief rally, it almost never ends with celebration. It ends with a brutal liquidation cascade. It becomes fuel for the fire. Right now, the data is flashing multiple warning signs all at the same time. This isn't just one metric. It's a confluence of red flags that are screaming caution. So before you get swept up in the hype and go all in, you need to see what I'm seeing. Let's start with the first and arguably most important chart. This is the open interest. Think of this as the total number of outstanding futures contracts that haven't been settled yet. When it goes up, it means new money is entering the market, making bets on the future price. Look at this spike right here, happening in lockstep with the price rise. This isn't gradual, healthy growth. This is a vertical move. It's speculative mania. These are traders, many of them likely retail, chasing the pump and using high leverage to maximize their potential gains. They see the price going up and they get FOMO, the fear of missing out. They jump in, betting that the price will continue to soar. But here's the problem. High leverage is a double-edged sword. A small move against their position can wipe them out completely. Now, let's overlay this with the funding rates. Funding rates are periodic payments made between traders to keep the futures price close to the spot price. When the rate is positive and high, it means the longs are paying the shorts. It shows there's an overwhelming demand to be long, even at a premium. And look what happened during this rally. The funding rates shot up. You have a massive number of traders all crowded on the same side of the boat, all betting on the same outcome, and they are paying a high price for that privilege. This creates a very fragile market structure. All it takes is one large seller, one piece of negative news, or just a slight dip in price to start a domino effect. When the price begins to fall, those highly leveraged long positions start getting liquidated. A liquidation is a forced sale. The exchange automatically closes your position to cover your losses. And when thousands of these liquidations happen at once, it dumps a huge amount of sell pressure onto the market, pushing the price down even further, which in turn triggers more liquidations. This is what we call a long squeeze. It's a cascading failure. The very leverage that fueled the rally up becomes the rocket fuel for the crash down. The market makers and the whales, they know this. They see this massive pile of leverage building up, and they see it as liquidity. It nests an opportunity for them to push the price down just enough to trigger that cascade and scoop up assets at a much lower price from all the liquidated traders. It's a classic, brutal move that we've seen play out time and time again in crypto markets. So while everyone else is cheering and tweeting to the moon, the smart money is often looking at the underlying data and preparing for the opposite. This doesn't mean Bitcoin can't go higher in the short term. It could. The market can remain irrational longer than you can remain solvent, but the risk is now significantly skewed to the downside. That pile of leverage is a ticking time bomb and the fuse is lit. It's not about being bearish or bullish. It's about being realistic and data-driven. It's about managing risk. The current euphoria feels a lot like the sentiment we saw at previous local tops, right before a major correction. The setup is almost identical. A sharp relief rally, a surge in open interest, high funding rates, and widespread retail FOMO. So my advice? Be extremely careful. Don't let the green candles blind you to the underlying risk. This might be the exit liquidity that larger players are looking for. Instead of chasing the pump, maybe it's a time to be patient, protect your capital, and wait for a healthier market structure to form. Wait for the leverage to get flushed out. A move built on a foundation of leverage is a house of cards, and right now, the wind is starting to pick up. Today, we're diving deep into a fascinating and frankly risky situation unfolding in the markets right now. I've been getting a ton of questions about this recent price bounce, with many people asking if this is the big reversal we've been waiting for. But when you look under the hood, the data tells a very different story, and it's one you absolutely need to understand to protect your capital. So let's break it down. We've seen a pretty sharp price surge, which on the surface looks great, but here's the crucial detail everyone seems to be missing. A massive spike in open interest at the same time. Now, for those who might not know, open interest tells us the total number of outstanding futures contracts. When it shoots up like this during a price rally, it's a huge red flag. It means traders didn't just buy with the money they had, they went out and borrowed heavily to place those bets. They use leverage. This combination of rising prices and skyrocketing open interest isn't a sign of market strength or stability. It's a sign of excessive, almost euphoric optimism. It's a market high on borrowed money, and that kind of high never lasts. Think of it like a party where everyone is spending on credit cards. It feels great in the moment, but the bill always comes due. And in the markets, that bill can be brutal. Adding another layer to this risky setup are the funding rates. They've flipped heavily positive. Now, if you're new to futures trading, funding rates are essentially fees paid between traders holding long positions and those holding short positions. When the rate is positive, it means the longs, the people betting the price will go up, are paying a premium to the shorts just to keep their positions open. This is a classic indicator of herd mentality. The crowd is overwhelmingly biased in one direction, convinced the price has nowhere to go but up. And here is a fundamental truth of trading. When the crowd leans too far to one side of the boat, the market has a nasty habit of flipping it over. Professionals look at this situation and see a clear leverage imbalance. It's a market structure that's incredibly fragile and ripe for a correction. It's like a Jenga tower where someone has pulled out all the stable foundational blocks and replaced them with wobbly, leveraged ones. It might look tall for a moment, but it's just waiting for a slight breeze to come crashing down. So, how does this typically play out? Well, it often starts with just a small dip in price. Nothing major, just a little wobble. But because so many traders are over-leveraged, even that small dip is enough to trigger the first wave of liquidations. These are forced sales. The exchange automatically closes their positions because they no longer have enough collateral to cover their leveraged bets. This forced selling adds new selling pressure to the market, which pushes the price down even further. This, in turn, triggers the next round of liquidations for traders who are slightly less leveraged but are now also underwater. This cascade of forced selling creates a domino effect. More liquidations lead to a lower price, which leads to even more liquidations. It's a vicious cycle that can accelerate a price drop with terrifying speed. We call this a long squeeze or a liquidation cascade. And structurally, the chart itself isn't offering much hope for the bulls either. We're seeing price approach some very significant resistance levels that have historically been tough to break. So you have a technically weak chart combined with a fundamentally fragile market structure built on leverage. This is not a recipe for a sustainable rally. It's a recipe for a trap. This is why it's so critical to not just look at the price, but to understand the mechanics behind the price moves. Don't get caught up in the hype. Be the trader who looks at the data, the open interest, the funding rates, and makes informed decisions. This is one of those moments where patience is your greatest asset. Chasing this move right now is like running into a burning building. It might look exciting, but the risk of getting burned is incredibly high. Stay smart, stay safe, and don't let FOMO dictate your strategy. If you've been feeling a little too optimistic about this recent market bounce, you might want to stick around for this. Let's zoom out and look at the bigger picture. What you'll see is that this little rally has been happening inside what we call a classic bearish continuation pattern. Think about it. We had a massive, sharp drop, and now we're seeing this slow, grinding climb upwards, but it's trapped under a ceiling of downward sloping resistance. This pattern isn't usually the start of a comeback story. It's more like the market is taking a quick coffee break before heading back down. So what we're seeing might not be a recovery at all. It could just be a reset, a deep breath before the next plunge lower. Now let's get into the nitty-gritty and talk about momentum. This is where it gets really interesting. During this recent rebound, the price managed to make a new high, but it was a pretty weak one. Meanwhile, if you look at momentum indicators like the RSI, they were pushing much higher, showing a lot more strength. This mismatch is a classic signal that traders watch for, and it's called hidden bearish divergence. What does that mean in plain English? It means buyers are putting in a ton of effort, pushing with all their might, but the price is barely budging. It's like flooring the gas pedal in your car, hearing the engine roar, but you're only inching forward. This is a telltale sign of exhaustion. When momentum and price are out of sync like this, it often signals that the original, broader downtrend is about to resume. But we can't just rely on charts. Let's add another layer to our analysis by looking at what's happening on-chain. On-chain metrics give us a peek under the hood, showing us what actual investors are doing with their money, and right now, they're adding to the concern. We're seeing a significant increase in coins moving to exchanges. Historically, when large amounts of crypto flow onto exchanges, it's not for safekeeping. It usually means holders are getting ready to sell. This suggests that some of the bigger players, the so-called smart money, might be using this small price rally as an opportunity to exit their positions and take profits before things potentially turn south again. Let's also talk about the behavior of long-term holders. These are the diamond-handed folks who typically hold through thick and thin. Lately, we've seen their convictions start to waver just a little. The data shows a slight uptick in long-term holders distributing their coins. It's not a mass exodus yet, but it's a crack in the foundation. When even the most steadfast believers start to sell, it's a signal we can't ignore. It implies that their confidence in a quick recovery is fading, and they'd rather secure some gains now than risk holding through another potential downturn. This subtle shift in sentiment from the most committed market participants is another red flag waving in the wind. So let's put all the pieces together. We have a bearish chart pattern telling us this bounce is just a pause. We have a hidden bearish divergence showing that the buying pressure is getting exhausted and failing to move the price significantly. And we have on-chain data revealing that more coins are being sent to exchanges, likely to be sold, while even long-term holders are starting to lighten their bags. When you combine the technicals, the momentum, and the on-chain fundamentals, the picture becomes much clearer and, frankly, a bit more worrying. It's painting a story not of a roaring bull market comeback, but of a deceptive rally, a bull trap, designed to lure in hopeful buyers right before the floor gives way again. Of course, nothing in the markets is ever guaranteed, and things can change in an instant. This analysis is based on the data we have right now. It's crucial to do your own research and manage your risk accordingly. But given these converging signals, a cautious and defensive stance seems like the most prudent approach at the moment. Don't let the green candles fool you without looking at the full context. So, you're watching the market chop around, and the big question on everyone's mind is, what happens next? What should we actually be doing right now? Let's break this down into a clear, actionable game plan, moving beyond the noise and focusing on strategy. This isn't about predicting the exact top or bottom. It's about navigating the probabilities like a professional. First up, let's talk to the long-term holders, the HODL army. If your time horizon is years, this kind of volatility isn't a signal to panic sell everything. However, it is a crucial signal for risk awareness. This is the time to seriously look at your portfolio and ask yourself, am I over-leveraged? When the market is euphoric, it's easy to take on more risk than you should. Now is the moment to correct that. Consider reducing any leverage you might be using. If you've borrowed against your crypto, this is a wake-up call to reassess that position. The goal is to survive the volatility so you can thrive in the next cycle. This is also the time to tighten your risk parameters. Maybe you had a mental stop loss that was very wide. It's time to define it more clearly. And most importantly, you have to avoid emotional decision-making. Watching your portfolio value drop 10 or 20% in a day is painful, but reacting impulsively is almost always the wrong move. Stick to your long-term thesis, but ensure your position is sustainable even if we see a much deeper correction. Do not let a sudden market drop force you out of a position you intended to hold for years. Now, for the short-term traders, the people playing the swings, your mantra right now should be confirmation over anticipation. The temptation is huge to try and catch a falling knife or short a weak bounce, but that's a gambler's game. In a choppy, uncertain market like this, it's far wiser to wait for the market to prove its direction. Let's say you're looking for a short position. Don't just short because the price looks weak. Wait for a key support level to break. Then wait for the retest of that level as resistance. If it holds as resistance and gets rejected, that's your confirmation. That's a much higher probability entry. Similarly, if you're looking to go long, don't just buy a dip because it looks cheap. Wait for the price to reclaim a key resistance level and turn it into support. Let the market structure shift in your favor before you commit capital. Breakdowns and breakouts should be traded after. They are confirmed, not in anticipation of them happening. Patience will keep your capital safe, while others are getting chopped to pieces. Next, what if you're looking to accumulate? You have cash on the sidelines, and you're waiting for the right moment to buy for the long term. For you, patience is literally your superpower. It feels exciting to buy a big green candle after a dip, that euphoric bounce that makes you think you've caught the exact bottom. But here's the secret. The strongest, most resilient entries often come after major volatility expansions, not during them. Think about it. After a massive price crash, there's usually a period of consolidation, a quiet, boring phase where fear is still high and nobody is talking about crypto anymore. That's often where the real bottoms are formed. That's your opportunity. Buying into a V-shaped recovery is risky. Buying into a confirmed bottoming structure is strategic. So don't feel FOMO watching these bounces. Let the market settle. Your goal isn't to catch the lowest tick. It's to enter at a level that gives you the best risk to reward for the next major cycle. The best prices often appear when it feels the most terrifying to click the buy button. And this brings me to the single most important rule that applies to absolutely everyone, no matter your strategy. Manage your position size. This is the alpha and omega of survival in any market. Let me be perfectly clear about this. Markets don't destroy trading accounts because people are wrong about the direction. You can be wrong 10 times in a row and still be profitable if you manage risk correctly. Accounts get destroyed because of one thing: oversized risk. Going all in on one trade, using too much leverage, not having a stop loss, these are the real killers. A 50% drop in price is a disaster if it's your whole portfolio. But if that position is only 2% of your capital, it's a manageable loss, a piece of data you learn from. Your position size is your volume knob for risk. When uncertainty is high, like it is right now, you turn that volume down. Small positions. When the trend is clear and confirmed, you can slowly turn it up. Never, ever put yourself in a position where one trade can wipe you out. So let's put all this into context. Why are we even having this conversation? It's about probabilities. When you look at the data, you see several factors aligning that increase the downside risk. We have a significant buildup of leverage in the system, which acts as fuel for a larger correction. We have structural weaknesses on the chart, with key support levels looking fragile. We're seeing momentum divergences, where the price is making new highs, but the underlying momentum is weakening, a classic warning sign. And you have a large amount of supply from long-term holders who are now in profit and might be tempted to sell. Could the price ignore all of this and just pump to a new all-time high tomorrow? Absolutely. The market can and will invalidate any thesis. But disciplined trading and investing are not about being a cheerleader for your bias. It's about looking at the evidence, respecting the risk, and positioning yourself accordingly. This isn't a Bitcoin is dead narrative. Far from it. This is a mature, professional discussion about risk management in a cyclical market. My name is Active John, and this is where we break down crypto with clarity. No hype, no blind optimism, just a data-driven perspective to help you navigate these markets. The goal here is to empower you with the right framework so you can make smarter decisions for your own portfolio. If you found value in this breakdown and want to stay ahead of the curve, make sure you're subscribed and have notifications turned on. And when a key level finally breaks, up or down, we'll be here to analyze the next move immediately, so you're never caught off guard. Now, I want to hear from you. Drop a comment below and tell me your strategy. Are you holding through this volatility? Are you hedging your positions? Or are you patiently waiting on the sidelines for deeper levels to buy? There's no right or wrong answer, but sharing our strategies helps us all learn. Just remember these core principles. The market rewards patience, it punishes greed, and it brutally exposes leverage. Stay sharp, think in probabilities, and above all, manage your risk. Thanks for watching, and I'll see you in the next one.